How's it going, y'all? Hope you're having a great day. Today we're going to talk about ETFs versus index funds, what they are, how they work. 2, we're going to talk about the 3 different types of index fund ETF investors. And 3, we're going to go over some different index funds, ETF funds, see how they perform, see which ones you might be interested in investing in moving into the future. My name is Trey. This is Investing by Numbers. If you're new to the stock market, make sure you hit the subscribe button. We've got lots of great information on this channel and education on how to give you better financial success moving forward in your career and your retirement and your investment portfolios. Okay, guys? Now, also, we are a new channel, so if you have questions, comment below. I will respond to every single question or comment on this channel. And hit the like button. Let's get into it. Okay, index fund versus ETF, which is an exchange traded fund. Let's scroll down here. An index fund is a type of investment that tracks a market index such as the S&P 500 or the NASDAQ 100 by investing in the companies that make up that index. Index funds can be mutual funds or exchange traded funds, ETFs. And some examples of these, of course, are the S&P 500 and the NASDAQ 100. Think about an index fund as your refrigerator. Okay, now if you're a single bachelor, you might only have beer and ketchup in there. But if you've got a family, you might have fruit, vegetables, meat, condiments, you know, all the stuff that's in your refrigerator. Think of an index fund as your whole refrigerator and think of the things inside it as individual stocks and or securities, things that you can buy specific amounts of. Okay, so the S&P 500 is 500 companies. All right, so the S&P 500 is the refrigerator and the 500 companies are what's inside the refrigerator. Now, an ETF is a collection of investments like stocks or bonds that can be bought and sold throughout the trading day like a stock. ETFs are a type of exchange-traded product and are listed on an exchange. So, whereas the index was the S&P 500 or the NASDAQ 100, the ETF is what you can purchase. All right, so it is basically what seems to be like a stock. So if you get on Robinhood or whatever you use to trade, it will be the S&P 500 index. You buy it with SPY. Okay, and the NASDAQ 100 is QQQ. So basically an ETF is just the means to buy the index. Now, you've probably heard people say that index funds or ETFs are the safest way to invest your money without much risk. And that is true, but it can also be false. There are ETFs out there that aren't as safe as others, and we're going to talk about that, especially in the end part of this video in part 3, where we show different index funds and ETFs and which ones are the safe ones to invest in for long-term profits moving forward on your hard-earned money. And we're going to also talk about, in this next section, about the different types of investors that buy ETF and index funds. All right, y'all. We have on the left side of the screen, we have the S&P 500 index. And on the right side of the screen, you can see I've got Robinhood pulled up, and I have SPY, which is the ETF of the S&P 500 index. And you can see here it says, you know, the SPDR, S&P 500 ETF. Now, both of these they go up and down together. This one's just the index fund, and this is the ETF that you can buy and sell throughout the trading day. As you can see here, we can look on the index fund side, and we can see a price of around $830 on January 23rd of 2009. And over here, we can see the same dip. January 30th, 2009, and it's at $84. And this on the right side of the screen is $84 a share, okay, that you can buy. So let's pull up that side. And yeah, we can see here we've got the max time frame. So this is going back all the way to the year 2000. And as you can see here, the S&P 500 ETF SPY or SPY has, we can see up here, since that year, the year 2000, we've seen it's gone up 333%, which is awesome return on your investment. So let's talk about the different types of investors that use ETFs and index funds. So right here, I'll just leave it here. All right, the experienced investor. Okay, guys, so this is someone that understands index funds and ETFs. They're someone that's going to be buying the ETFs in their own brokerage accounts. Basically, they know what they're getting. They're the type of person that they're not interested in beating the market. They want to get right there with the market. So when they have money to invest, they pick a ETF to buy, and that's where they put their money. And as long as they're picking the right ETF index funds, they're going to make great money for years to come. Index funds, ETFs, they're a great way to build wealth over time with very minimal effort. And we'll look later on to see the safe ones out there, the type of returns they bring. And number two, the beginner investor. So ETFs are a great way to invest for someone that's new to the stock market that really wants to learn more and build wealth and run their own retirement. So let's say even if you want to get into investing in individual stocks, I'm always going to recommend for a beginner investor to start with ETFs. And preferably, if someone comes up and asks me what to invest in, I'm going to say, look, the S&P 500, it's a great one, SPY, and then also the NASDAQ 100, QQQ. Now, NASDAQ 100 is more of a growth stock ETF, so it might have more upside in the last few years, but also when we hit a downturn in the market, when we have a pullback, or if we go into a stock market crash era, the QQQs likely will drop further than the S&P because they're a little more volatile. And we'll look at that later too. And three, the retiree. So for instance, with me, I invest in individual stocks. That's what I like to do. That's my passion. I love researching companies, and I like putting in the work, looking through all these different companies, finding stocks and companies to invest in, and I get real excited about that. And I have, on average, over the last 8 years, I've gotten a return of about 25% per year on average, which has me on average beating the market. But I put in a lot of work to do that. You could put in a lot less work and just invest in the S&P and still have great returns. Now, the retiree would be someone like me that maybe I'm near the end of my life as far as my work life. And I know that in the next couple of years that I'll be living off the money that I've built, the retirement I've built throughout my lifetime. And so I'd be looking, perhaps I might decide to slowly scale out of my individual stocks and put that money into index funds that have a little more safety, that I don't have to worry about my money. They have, of course, the S&P and the NASDAQ, but there are also dividend ETFs that are a little safer. They don't have as much upside, but they pay out dividends and they're not as volatile. The retiree is another person that's going to be putting their money into ETFs for more safety, and still they'll get upside over time, but they're just going to have a little more peace of mind having all their hard-earned retirement money sitting in an ETF. So let's look at a few different ETFs and just kind of analyze them so you can get a feel for what you'd be looking into if you were to invest in an ETF. This is the SPY, the S&P 500 ETF. And if we put the max chart on, we see that, let's see, go back here, and we're at February of the year 2000. We've got that 333% return. Now that's about 25 years. And so if you do the math, that if you invested all of your money back at the beginning, now you would have gotten about a 13% per year return, which is awesome, guys. I mean, that's fantastic. Now, if you were investing more money throughout this time period, of course, you wouldn't have 13% every year. Every year would be a little bit different, but you see that this thing just keeps going up and up and up, and it's done that for decades upon decades. This thing just tracks the market, and it gives safe returns that you don't have to worry about. You don't have to do any research. You just come into Robinhood, buy some shares, and let it ride. Now the Qs, the NASDAQ Top 100, QQQ. This one goes back about the same distance. And if you bought in 2000, January of 2000, around the same as what we were just looking at, we've gotten almost a 500% return since then, which comes out to about over 19% per year. So that's even better than SPY. Now, however, generally, I think I said this earlier, when you have a market crash, the QQQs, the NASDAQ is since they're growth stocks, a lot of the indexes, it's going to have a bigger downside. But overall, bigger downside equals a bigger upside, and that's what we see here in the QQQ. Now, also, I talked about there are some ETFs out there that are a little riskier. For instance, we've got ARK investment, which is Cathie Wood's ETF. And if we go to Max here, you can see this goes back to October of 2014. Now, it is up since then. It's up 188%, which is about 10 years. So that's around 18% a year. But look at this, guys. A lot of people got really excited about ARK during this 2020-2021 phase, but we see what happened. These were all high growth stocks that she was investing in. If you scroll down, you can kind of see what's in the ETF. We've got Tesla, Roku, Coinbase, Roblox, Palantir. These are all high growth stocks, but they were definitely highly valuated up here at that point in time. And so we had a big crash. And from here, we haven't seen this ETF make a comeback. And so it's since, it hit its top January of 2021. So 4 years ago, it hit its peak, and it's not even close to getting back there. So not every ETF is created equally. Now, this doesn't mean that ARK won't come back over time and surpass those highs and have some high points again. But don't trust every single ETF just because it's an ETF. If you're going for something safe, SPY, the Qs, those are the ones I'd stick with. Those are the ones that I would feel safe investing in if I was a new investor, and if you wanted to, you could put half your investments into SPY and you could put half into QQQ to kind of run the difference, or you could pick one. Also, if you're a new investor and you're looking to get into individual stocks, I highly recommend getting used to depositing money into a brokerage account like Robinhood or Charles Schwab. Those are the two I use, or any others, weekly or at least monthly. Like, for instance, if you get paid every other week, when on payday, you put a percentage of your paycheck that you can afford into a brokerage account to start buying stocks or ETFs. And even if you're just now starting to learn about investing in stocks, starting out investing in an ETF is a great way to dip your toes into the pond and really start understanding what it's like to deposit money into a brokerage account and buy shares. And you can start buying shares of SPY or QQQ. And then as you gain some knowledge and you get more comfortable with investing in individual stocks, you could start, maybe putting half your money into index funds or ETFs and then half of it into individual stocks, and just kind of play it safe over the long term. And if you had good returns from your individual stocks, you could slowly start moving into that. But investing in individual stocks is really risky. If you don't know what you're doing, what you're studying, individual stocks, you can lose all your money. You could put your money in into companies that everyone's telling you are going to do great, and they go bankrupt. It happens all the time, guys. Follow this channel if you're in that mindset of wanting to learn more about investing, whether it be ETFs or individual stocks. I'm an individual stock investor, but I like talking about ETFs. We give a lot of knowledge on this channel, so please subscribe and stick around watching our videos that we come out with. And other than that, guys, I hope you got a lot of info from this video. If you have any questions, comment below. I respond to every comment, even if it's mean and you hurt my feelings. I'll still try to say something positive to you. On that note, guys, have a great day. Goodbye.